better hedge funds have done relatively well versus all asset classes the last 7 years. It's true that the broader indices have struggled, but those that have a firm view on themes, manager selection, and evolving their portfolio have actually done, on a relative basis, fairly well. So, you know, the premise that all hedge funds have struggled is clearly not accurate to start with. If you look forward, however, though, over the next 5 years, we're fairly convinced that the next 5 years for every asset class will be more challenging than the last 5. You know, since the crisis, equities have had a meteoric rise. The Fed's quantitative easing policies have at least had something to do with that. I think there's very few that would have expected such a strong performance from not only equities but bonds, but that's what's happened. Now, if you look forward, primarily because risk premium more compressed, valuations are more stretched, and quantitative easing is ending, we think all assets, whether it's equities or bonds, will have lower returns with higher risk. Now, hedge funds should have similar to marginally lower returns, but they should not suffer nearly as much from the end of quantitative easing, not only because their strategies aren't dependent upon equity appreciation, but also because they can short, and shorting during quantitative easing has been very challenging. You know, furthermore, the bad news for all investors right now is that fact that their opportunities aren't as great as they were, say, at the end of 2008 or the end of 2011. The good news, however, is because of the disintermediation of the banking system, which is basically a fancy way of saying the regulators and the politicians have kicked banks out of capital markets due to what happened in the crisis, many hedge fund opportunities are far more lasting in time and far more significant. So if you look at mortgage-backed securities, whether it's prepayment sensitive or credit sensitive, if you look at more complex high yield, if you look at European bank deleveraging, if you look at Basel III banker capitalizations, even if you look at event-driven equity, all those strategies are benefiting on a secular basis from lack of prop desk competition and the fact that market makers don't have any balance sheet anymore. Furthermore, there are some strategies like Basel III banker capitalization that only exist because of regulatory reform. So there's good news and bad news. Bad news is cyclically, opportunities aren't as great today for any asset class as they were at the end of 2008 or the end of 2011. Secularly, however, there are certain strategies that continue to benefit from this powerful secular force of bank disintermediation.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Capital Multi-Advisor Hedge Fund Portfolio Series G, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.